Hi everyone, I just want to do a quick video continuing on the series with the 1040 here. Today I wanted to talk to you about doing the Schedule A. Now most Americans, most taxpayers might be using the standard deduction with the increase in the amounts. If you weren't aware what happened previously in the last tax season, we've had some adjustments there where we increased the standard deduction and got rid of the exemptions on your return that you might have used to have for yourself, potentially your spouse, or any dependents like children. Now, if you don't take the standard deduction, if you have what are so-called itemized deductions that increase compared to that standard deduction, you might file Schedule A. That's where you would list out all your itemized deductions. That's where you would itemize those. What goes on that return, on that schedule, that form, you'll see are medical expenses, taxes, mortgage interest, other investment types of interest, and what used to be 2% miscellaneous deductions, which used to be just some one-off deductions that you got to receive as long as they rose above 2% of your adjusted gross income. Now, those have been taken away from this tax law here. So those don't come into play, but you might see those on your state return. Similar to the itemized deductions that had a hurdle there, the medical expenses, most people aren't going to hit. In the past year, it was around, the limit was, the threshold was 7.5%, but that's been bumped up in 2019 to 10%. So you have to have qualifying medical expenses that rise above 10% of your adjusted gross income before you can even start taking those deductions. Now, some of those things might be medical premiums that you have, out-of-pocket medical costs, things that your insurance won't reimburse you for. So most don't actually have that unless you're older or have some medical issues that might increase your bills. The next line is your state and local taxes. So that will be where you list out your state income taxes, your property taxes paid. For states that don't have either or are small, you might actually be able to take the sales tax you paid. So that's something you want to look out that most people overlook. If you paid a lot on sales tax for any particular reason, look at that amount. Now, in the given year and in 2018, what we saw is that's actually been capped down to $10,000. So that's a big change that we haven't seen in the past, where you used to be able to deduct all your state income taxes that you paid as long as you were outside the alternative minimum tax. So that will get capped, and that is pushing even more people into the standard deduction. After that, you have your mortgage interest. So if you own a home, condo, any kind of property, as long as you're not taking rents and such, which would go on a different form for your primary living home and one other home that you have, you can deduct mortgage interest. Now, there's a limit on that. You can only deduct mortgage interest now, currently in 2019, on homes up to $750,000. So the vast majority of people aren't going to run into that limit, but that's also something that if you live in a high cost area, parts of New York, California, Washington, you want to kind of look out for, because you might hit that limit as well, and then you'll have to adjust those numbers down from there. Another important number is charitable deductions. That's for anything for cash to most charity organizations, 501c3s. You can deduct 60% of your adjusted gross income. So if you have $100,000 of adjusted gross income, you could actually deduct up to $60,000 for charitable deductions to qualifying charities. Most people don't hit that limit, but it's good to know that if you are charitably inclined, you can see a deduction for those amounts. Those will all come together with some other just miscellaneous things on there that are still allowed, and that will produce your itemized deductions. That will go on your 1040. Now on your 2019 return, it's still on page 1, and that will get deducted out of your adjusted gross income before you hit your taxable income. I hope that helps. If you liked it, hit the like button, comment if you have any questions, and feel free to connect. Thanks, guys.